Hey everybody, I just wanted to drop a quick video. There's something very interesting going on this week, which carries into next week just by a day. And it's worth mentioning because it has such a big effect on markets, and we're seeing that play out over the last couple days. So it's called the JPM collar trade. It's like a kind of collar buffer trade, where effectively you sell an upside call and you use that to finance a downside put or a downside put spread. In this case, it's buying a downside put spread. So what they do is they hold the S&P 500 index and they buy a 5% out of the money at the 3-month mark, and they sell a 20% out of the money to create a put spread to the downside. That's your protection. They sell a 103 call, which means 103 means 3% above where we're trading now. So you can think of that sort of the parlance in the options world is, the 105, the 110. Well, the 110 is just 10% out of the money call. The 90 is a 10% out of the money put, just so you know these things. But a 103 means the new call that they roll into is going to be positioned 3% at a strike that's roughly 3% above where the market's trading now. So at the moment, that would be kind of, let's say in SPY terms, around the 590, 588, 589 kind of level. What makes this trade interesting this week is we happen to be right at the meat of this particular trade. So the long call that dealers have, right? The caller is selling the call. The clients are selling the call effectively when they own that product. So the dealer has taken on the other side of that. They are long, massive amounts of calls, as well as other outstanding option positions that exist at that 57.50. So, $10-12 billion worth of outstanding calls at that level. And what that does is it puts a clamp on things. So let's explain it like this. I did go over something like this in another video, but you probably can't go over this stuff enough if you're not as familiar with these concepts. It sort of takes a little bit of revisiting. And so I'm happy to do that. And so think of how a call works. We know that at expiry, an out of the money call is going to be worth 0. The delta is going to be 0. And in the money call is going to have some form of intrinsic value, right? Could be 10 cents, 50 cents, $18, whatever, but it's going to have some intrinsic value, no time value left. That delta is going to be 100. 3 months before that, the delta of the call, even way below the strike, could be 20, could be 15, could be 25. So there's still some delta, but on expiry, which is right about where we are now, these are going to be rolled on Monday. There is September 30th expiry. Right now, they have this huge outstanding gamma, which we call it, at that 57.50 level. So what that means is, as the market has come up towards that level, it's acting as resistance, because as we get closer to it, when there's a little bit more time left, you're able to sell futures against that, sell stock futures. You're able to sell the market against that, because when those calls are worth something, you're trying to neutralize all the time. Dealers are always trying to stay relatively neutral. They're not trying to stick their necks out too much. So at this point, what is going to happen is they're probably going to have to start buying some of that stock back as we get very near that expiry, because if they're short against these, they can't be short against calls that are out of the money, so they're going to have to buy that back. But then once we get above 57.50 or right around 57.50, they're going to be selling. They're sellers, right? Let's take a look at how this works. So let's say I have 100 calls. I'm going to keep it to the SPY at 575. Above 575 on expiry, when these are either worth something or nothing, when the delta is either 0 or 100, 0 delta or 100, whether they're out of the money or in the money. So above 575, we're going to have to sell 10,000 shares against those calls. And then if we do sell them and the market goes below 575, well, guess what we can do? We have a synthetic put, so we're going to buy that stock back. So what happens is you can kind of gamma trade back and forth with this position if you're long it, which you have to do because it's eroding and you're losing money in theta. You're losing that decay, so you need to trade back and forth. This is something I did for a dozen years. You're trading against this position to try to make up for all that theta decay. And if your theta decay is 50 grand and you trade and your trades are worth 100 grand, well, then you're up 50 grand on that overall package at the end. So you're trying to make more than, if you're trying to trade for profit, you're trying to make more than the cost of the position. So you're always trying to buy low volatility and trade against it. And so above 575, the market has a whole bunch of shares to sell. And that's what's happening here. We can see that as we approach this September expiry. Look at all this massive amount of gamma. This bottom part of the chart is showing you the gamma. Here's your VIX index. It's very low. And what happens in these kinds of markets is you get this clamp, right? There's so much stock and futures for sale around 57.50 that the market has trouble getting anywhere. And that's what happened this morning. And remember, yesterday we had sort of a 20, 25 point drop in the SPY, and it came right back. Why is that? Well, because below this, if anybody's short against these already, they're going to be buying back futures. So it acts as support below, and it acts as resistance above. It acts as support on the downside below that strike, and it acts as resistance above. And so here we are, and I can tell you this, you get less and less patient as you approach expiry. With 3 months left, you're probably willing to sell it at 5,900 or 5,850 if you're trading a little bit more discretionary. But these things expire on Monday. So you need to be able to trade this right now. So what happens is the clamp gets tighter and tighter and tighter as you approach that day of expiry, which is where we are now. We're kind of coming right into the tail end of this. And so there was stock to buy yesterday, which supported the market when it tried to sell off. There was some news that came out that pushed it down a little more. And guess what happens? Micron comes out and fantastic numbers. It reinvigorates the market. What happens? We open up right near that strike and a little bit above, and they hammer the heck out of it with futures because suddenly all these dealers are like, it's Christmas. We get this big move, and they're able to sell a whole bunch of the market in here, which they are now going to be buying back. So they've been buying that back the rest of the day as it comes down and the rally fails. So it's not a huge surprise that the rally failed. Now, I will say that these things are no guarantee, right? If the market has enough organic momentum to it for whatever reason, gamma levels may not be as important. Today it was. This is a huge, huge position. So it seems to have had an effect on things, which is interesting. And tech has kind of run into a bit of a wall, as semis ran into a bit of a wall, even though that news was quite favorable. So there was a massive, massive amount of futures and stock for sale up there. And now as the market comes off, they're buying it back, buying it back, buying it back up around here. And if we pop again tomorrow or this afternoon, guess what? The same stock will be available for sale. And it'll happen on Monday. It'll happen tomorrow. And on Monday, everything gets rolled. So they're going to roll out. So we're going to lose a huge amount of gamma. Now, this happened on Nvidia. So if I can give you an example, I talked about this in another video. I said, listen, there's a lot of gamma at that 120 level on Nvidia. And it was kind of trading around. It had trouble getting through 120 before SEP OPEX, and it just couldn't do it. A lot of stock for sale, right? That's part of the reason. Massive amounts of stock for sale. Pulled back to about 116. And then guess what happened this week? The coast was clear. I call it, you're free to move about the cabin again, right? The market suddenly doesn't have this clamp, and we went to 127, I think, on Nvidia. Now, it's not the only reason it went up there, but without that stock in the way, it's certainly an easier thing for the market to handle. And that's what happens from week to week. And there are services that will give you an idea of where this positioning is and where you can maybe expect resistance and support and call walls, put walls, etc. It's a little bit specialized stuff. I'd say it's more important to probably shorter term traders, but as in this case here, I put on an Nvidia call spread, and we're doing fantastic on it because I knew that gamma was going to disappear. Boom, we flew through there. Semis, of course, got a hand from Micron, but Nvidia was already off to the races yesterday. Barely pulled back, even when the market pulled back. So we have this gamma support, we have this gamma resistance, and that's where we're sitting right now. And there's another extra feature that comes with this sort of this dynamic, which is charm and Vana. So if you pay a little bit more attention in your option trading, you're going to notice that as you get closer to expiry, an out of the money call or an out of the money put, delta will drop. And so as the delta drops on an out of the money option, dealers have to buy back hedges that they may have previously sold, right? Against puts, against calls. And the same thing happens above. The delta will move slowly towards 100 as you get closer to expiry on an in the money call. And that charm effect is going to basically create more of a supply of stock. So when volatility is moving around, when the VIX is in motion and moving around, you start to get these extra things happening. That's Vana. There's an effect from a rise or fall in implied volatility on delta as well. But for now, the important thing to take away from this video is that there is lots of support below, there's lots of resistance above. You can kind of trade around that. Remember, I told you this is just one piece. I happen to think it's a big piece, and we saw it play out very well yesterday when we came back from that sell-off, and we saw it play out very well this morning as they absolutely hammered yesterday's implied move was less than what we got this morning. So Micron was a gift to market makers as this thing opened up and they were happily hammering away at that future. Now, what happens next week when this position is rolled up to perhaps 5,900? Well, this resistance and support is gone. And that's why I say we're free to move about the cabin when these positions disappear. So good things to keep in mind, whether it's on the index, which is what we're talking about today, or in an individual name. You could have these positions, in particular, Nvidia up to recently had some sort of negative gamma. And I talked a bit about how that works in another video. And that actually exacerbates move. When you're negative, when you're short gamma and you're a dealer and you're going to have to chase things. You're going to buy into strength and you're going to sell into weakness, which is why the market was partially why I was having lots of trouble down around the 5,300 level about a month ago. Very volatile environment because of the negative gamma dynamic that was playing out. So these are all kind of important things for you to keep in mind. If you like this, please subscribe, follow me, get on my newsletter, and I talk about stuff like this. I also talk about, the basics, covered cash secured puts, covered calls. I ran, almost $1 billion of option overlay funds, covered calls, downside protect, black swan funds. So you're going to get some of the more in-depth stuff like this, which I think just makes you better and more knowledgeable. And I think it's more important than ever, right? That tail is starting to wag the dog. The derivatives market is big now, bigger than when I started. Boy, it was nothing back then. It had no effect. Now this has an effect. The tail might become the dog in a sense. The derivatives market is probably going to be the dog at some point, moving markets around on a regular basis. So you want to know this stuff, sign up for my newsletter, look at my programs. We talk about things like this. You want to be a better all-around trader and certainly knowledgeable in all aspects of what's going on out there in the derivatives and options trading world in order to be better at this. It's as simple as that. So hopefully you enjoy that, and we'll see you in the next video. Thank you.